Hi there, it's Phil and John from Golf Data Tech, and we are here in sunny California enjoying some good client meetings this week. We thought it might be a good opportunity, as we're both in the same room, to have a little discussion on what is going on with the golf market in the US so far this year. Obviously, it's been a time of change. Lots of questions being asked about what has happened this year in terms of sales and what we think is going to happen moving forward. So, John, if you could just give us a bit of insight from your wealth of knowledge as to what's happened so far this year and some of the reasons why.
Yeah. Well, obviously we're coming out of the pandemic and golf was booming for most of 2021. We're seeing a little bit of a peak here in the first quarter of 2022. Sales have leveled off in total, with consumables still up a little bit, gloves, balls, and the clubs themselves are down slightly, primarily due to some supply constraints. You just can't get enough golf clubs, and for right now, it's hard to say is the decline in clubs, is it directly related to supply, or is it consumer demand that's slowing? It's perhaps a little bit of both, but certainly if we were able to make as many golf clubs as we have orders for, things would be much different.
Okay, so you say obviously that the market is flattish at the moment, or a little bit down. If we look at some of the most recent numbers, actually there's quite a difference in terms of units and in value.
Right, yeah.
So what we've seen is quite a drop in some of the units relative to the value because the ASPs are so high. Is that be correct?
Yeah, absolutely. The average selling prices are up dramatically. Our units, particularly in some categories like irons, are down 15-18%. Pretty significant decline in units. However, it's being offset by significantly higher average selling prices. Sometimes it's because of the custom club makers, custom club builders, and the combination of there's not any inventory in the field to sell at lower prices, so there's no closeouts. So the combination of the two, the average selling prices are way up.
Okay, so in terms of inventory levels and things, would you view the basic market as being pretty clean at the moment in terms of a lot of what's being sold is not going to be replaced, or have we got stuff that's hanging around which basically maybe isn't optimum?
There's really not anything left over. You know, the market is pretty clean. We have seen inventories for the first time in March of this year start to build up, particularly on the club side. But they're so far below where a healthy place to be that we have a long way to go. So not only do the manufacturers need to catch up on their consumer deliveries, they also need to build some inventory at the retailers, and then they also need to get inventory in their own back rooms, to have stock, to safety stock. So as of right now, there's a lot of room for growth. It's just a matter of getting the components to flow so that they can put them all together.
Okay, all right. So we've seen a solid, if not not spectacular, start to the year with some softening in some areas and constraining others. How do you see it moving forward for the next quarter, moving towards the end of this first half?
Yeah, I mean, I think we'll be fine for the next quarter for sure. Q3, Q4, we might start to see some softness. There's a lot going on in the world, obviously. You've got a war going on. You have inflation running very hot. All that's impacting the ability of consumers to have money, discretionary funds to buy golf clubs or to go play golf. So we're always concerned about the macroeconomic things going on, but for right now, things seem to be okay. We'll just have to wait and see how Q2 plays out. It's as I said, there's a lot of supply constraints, and if we don't catch up on supply until July or August, a lot of times people are going to delay those purchases, and that can be a real problem.
Okay. So it's going to be pretty critical over the next couple of months, monitoring both the inventory and the sales to make sure that we don't overshoot. Obviously, if the inventory is being constrained, I'm sure there's quite a lot of desire to get product in, and if we're in a situation where we're starting to see some of the units soften, units in particular, it's going to be a tricky time to navigate through to make sure that we hit the right balance between getting inventory in and replenishing, and also being in a position to keep the inventories at the right level, so that we're then not in a need to actually do any clearance.
Yeah, I mean, and that's obviously your goal, is to try to balance having enough inventory to meet demand and not having too much inventory, so you have to close it out at crazy prices. And so the industry's done a great job for the last 3 years. Prices have stabilized and risen. Now we just have to hope for the best, and that we don't end up with, the pendulum tends to overswing, and we don't want it to overswing and bring in too much inventory as demand slows. But for the moment, demand seems to be there. Just have to wait and see.
Okay, cool. Well, hopefully that's given some of you a little insight into where we are so far in the market, and obviously John's given some really useful kind of insight as to where we think we're going to go in for the next quarter or so. We'll obviously keep producing the numbers to keep everyone up to date as to what really is happening, and hopefully that'll guide and inform brands and retailers alike to help them navigate through these tricky times. So we will be back with a few more numbers and stats in the coming months.
Yep. Thanks.
Cheers.